Okay, so hello everyone. Welcome to Paytm Money Talk, and I'm your host Neeraj Gugoi. And today we've got a very interesting topic. In fact, Nifty 500 Quality 50 Index Fund. And with me, I have Mr. Vikas Wadekar. He's a fund manager with Axis Mutual Fund. But before I start the whole session, let me read out the disclaimer for this event. Investment in securities market are subject to market risk. Read all the related documents carefully before investing. Representations are not indicative of future results. All discussions are purely educational in nature and are in no way an advice or recommendation. Now, having said that, Mr. Vikas, he has got more than 2 decades of experience in the industry. Currently, he is with Axis AMC, joined in April 2024, and looking after passive fund business and quant side of the business. In fact, he had worked with AMCs like Island and FS AMC, INZ Vesha, Benchmark AMC, Union KBC AMC, etc. So great to have you, Vikas. Welcome to the show.
Neeraj, thank you so much for inviting. Excited to talk to you and your investors.
Thank you. Because in fact, it's a great time because many a time, people are a little bit confused, scared, because there are so many things that are happening in the market. You talk about, the Trump tariff. In one side, then on the 15th of August, we have got GST reform that's around the corner. So how do you see the market? And again, when the whole world market is touching all-time high, Indian market is somehow it's not performing as it should have been, right? So, what's your take on the market as a whole for our investors?
Yeah. In fact, I would put it slightly differently. I think this is the time of accumulation. Like, okay,
Okay.
last 2 years we have seen market rising, leaps and bounds. We have seen fantastic returns, right?
Mhm.
But stock market is always not the straight line, right? You go through
Mhm.
volatility, you go through expectation, and stock market is actually to build on what lies in the future, right?
Right.
So this year you will see a lot of volatility, and this is a great time to accumulate. I would suggest, SIP is definitely a good route, but suppose you are an aggressive investor and looking to, maximize your return. Whenever market falls more than 2%, I think that is the time you should be investing. Okay, and you will get such multiple opportunities this year. This I'm talking next 12 months also, because the tariff, which I feel is not gonna end so soon. Okay,
Mhm.
the it's whether it is tariff war or whether it is actual war, this situation will always disturb. If you look at India as a country and economy, we are not in trouble at all. We are actually in good position. But if my neighbor is in trouble, definitely those it's gonna affect me. You name the country and just put a finger on the global map, you will see everybody is in problem, right? Except India. As we say, Vasudhaiva Kutumbakam, right? Everybody depends on everyone. So we can't say that if I am not part of that war, I am not part of that. You will always get affected because of this. But yes, good time lies ahead. GST reform, first of all, GST introduction and reform has changed the entire paradigm. The government revenue also, whatever's gonna what coming very soon, that will also help definitely government as well as investor. What we see, but trust me. There is no single train, but just get into opportunity. Whenever you see opportunity, participate in the market, hold it for another 3 to 5 years. You'll definitely make good returns out of market.
Fantastic. You say that this is a time of accumulation and investing is all about long term, right?
Correct, correct, absolutely,
Okay,
absolutely.
great. Now let's talk about investing style. Coming straight away to the point, active and passive. Now, of late, we have seen in last few years, passive investing style is really picking up.
Correct.
And now, what is it? Passive investing is all about, and what is the difference between active and passive? Just can you briefly give us
Yeah.
some kind of an idea about that?
Sure, sure. So I'll again give a different perspective. Then if you look at active management, definitely there is an active manager. He has an, a list of analyst which covers top to bottom or a bottom up approach. There is an investment framework, right? The companies has to fit in those framework, whether it is a style, quality or value, whether it is the sector, themes, and then they build a portfolio. That's called active management, right? They also end. So while looking at entire portfolio, what you say, quality, they also want to look at to beat the benchmark. That's the objective of active
Mhm.
investing. But when it comes to passive, there is no fund manager as such, right?
Mhm.
It's just an execution fund manager. He doesn't do anything
Okay.
research as such, okay?
Mhm.
Because there is an index which is different, designed by NSE or BSE, and you
Mhm.
just replicate. Okay, but
Mhm.
here there is a twist. When we say benchmark, okay, benchmark. So for you, if I ask you question, Neeraj, what is your benchmark for your life, right? We always keep
Okay.
benchmarks high, right? We don't keep
Mhm.
benchmark which is low, right? So
Mhm.
there is something in those benchmarks, something, whether it is Nifty 50, Nifty 100, or Nifty 500. If you broaden the universe, there is something in it. And what is in it? I'll
Mhm.
just give you one perspective. If you go 30 years back, how many participants were there in the financial market? Right
Correct.
now, look at how many fund. We have 1,500 minimum registered fund manager with SEBI. If you
Mhm.
collectively look at all PMS, AIF, mutual fund managers, right? Then you have treasuries, then you have analysts, so much FIIs, financial institutions, bank, treasuries, investing. So you have so much of intellectual capital has come in. So your market is no longer that SSC classroom. Now your market has become IIT classroom.
Mhm.
So, passive investing is nothing but your IIT classroom. All these fund managers' wisdom actually represented by an index. Okay. Because see, market is limited, right? You have 500 liquid stock. So everybody is doing
Mhm.
research there. And as you do more research, the market starts becoming efficient. And that is why passive investing is like, I would say, how many fund managers for passive funds? I would say 1,500 fund managers, right? Because everybody who's contributing to the market is actually reflecting in an index. So it is common wisdom, in short, common wisdom of all the market participants you get through an index that is called passive investing.
Okay. Uh, no, great. Like really, I liked the analogy that you have given. Now, when you talk about mutual fund investing, everybody think about the alpha generations. How much additional. So, from attractiveness point of view, how the passive funds are being attractive to the investors, and what are the advantages and benefits of passive investing?
Yeah, definitely. So as we said, there is no fund manager, there is no research. Okay, though definitely
Right.
the cost of fund scheme is very low. Okay, which
Hmm.
starts as low as like 10 basis point, to maximum 1%. That to on a regular plan. Direct plan it's much lesser. You will always find anything and everything less than 0.5%. Right. So cost is very low because there is no research actually. So that's the first advantage, which Vanguard Jack Bogle, who is the founder of passive investing, he always spoke about. The cost will help you in long term. Second is churning. Okay, the index gets churned only twice a year, every 6 months.
Correct.
Okay, so your portfolio is not churned too much. So that is also an underlying cost which gets saved, right? Whether as an active manager, you will see a lot of churning happens to generate alpha. Okay.
Mhm.
End of the day, if you look at post cost, you will actually end up beating most of the active managers. But still, you will
Mhm.
get a market return. Now, when you talk about alpha over market, whether it is Nifty 50, Nifty 100, Nifty 500, then yeah, there is a new style of investing, okay, which is
Mhm.
very popular, which is factor investing, or also called smart beta investing. You can always look at them, to maximize your return over your broader benchmarks as well. Though it's a passive, but those styles are smart. Those styles are, styles of investing, which gives you that additional alpha which you're looking at.
Okay, great. Now again, the topic for today's discussion, of course, you talked about smart beta. It's a smart beta fund, Nifty 500 Quality 50, and Axis is already launched an NFO that's going on. Now, is it absolutely a passive fund, or it's somewhere between active and passive? So how you say it's a smart beta, and how why should the investor invest in a smart beta fund?
Absolutely. So, so far, we always thought
Hmm.
that alpha generation and style investing lies with an active manager. Because we always knew, we grew knowing Sensex and Nifty 50. Okay, we never thought that any index can be of particular style, whether it is a quality style or a
Hmm.
value style. We never thought of it. Okay, but that factor investing, which brings you that flavor. Okay, so I'll make it very simple. It's a quant model. Okay, so
Mm-hmm.
it's like a mathematical model, very simple model. So you pick up a universe. You pick a particular universe, which is say Nifty 100 or 5. In this case, it's a Nifty 500 universe, and you pick up all those stocks which are quality in nature. This is one
Mm-hmm.
factor, or value in nature. There's a
Mm-hmm.
second factor, right? So becomes a quality fund, becomes a value fund. Now, how do you define it? So index providers have defined it. Okay, when you look at
Mm-hmm.
quality, they defined in terms of the ROE, return on equity, how much
Mm-hmm.
company money has generated based on the equity capital. Second is what is the leverage ratio, debt equity ratio, very simple to understand. What is the, and third is the, what is the consistency of EPS for last
Mm-hmm.
5 years. Okay, these are broader, and these are the only three parameters are filtered, okay, amongst the universe of 500, and you get a result of say 50 stocks, or some cases 30 stocks. Okay, so
Mm-hmm.
that filter is a smart filter. So universe is decided like 100, 500, here in case 500, and you put that smart filter where you get quality stocks based on ROE, debt equity ratio, and EPS consistency. That's how your portfolio becomes smart. Okay, so there you get that style out of the main universe. That is what is called a smart investing.
Okay, so you talk about quality. You have underlined what are the parameters, and what are the other factors? You talked about momentum as well. So these
Yeah.
are the two factors, and there are some more factors as well.
Yeah, so there are four factors. In fact, there are five
Mhm.
factors. So second is value. Value
Okay.
looks at the valuation of the companies, which is broadly known by the PE, by a PE
Mhm.
ratio, your price to book ratio, price to sales ratio, and dividend yield. Okay, so dividend yield has to be
Mhm.
higher, or other three parameter has to be lower. So if you
Mhm.
put that filter on 500, you will get a value portfolio. That's a
Value
second.
set of
That's a
stocks.
separate, yeah. So one first we got quality, second value, third now you're looking at momentum. So momentum considers no balance sheet data. It considers only the price movement. Okay, so it looks at price return, but
Mhm.
that price return is adjusted for standard deviation volatility. So in very
Mhm.
short, simply to understand, 6 months risk adjusted return and 12-month risk adjusted return. Price return of
Mhm.
that particular stock. The best
Mhm.
risk adjusted return stocks are part of the momentum. That means the
Momentum.
stock has
Mhm.
to has must have performed best in last 6 months as well as last 12 months.
Mhm.
Okay, adjusted to
Mhm.
volatility are become part of it. So all stocks which are trending, okay, will become part of it. Now there is no quality parameter here, there is no valuation parameter here, only return is the parameter, price return.
Mhm.
And the
Mhm.
fourth style of our factor is called low volatility, okay,
Mhm.
which considers the standard deviation of the price movement of the stock. If there is a
Mhm.
too much of price movement has happened, that stock will be avoided. Okay,
Mhm.
only lesser standard deviation stock will be part of the index. Those are basically defensive in nature. Like if you look at ITC, Colgate, okay, Gillette, for that matter, you will not see price movement too much because their book is consistently growing. So these are
Mhm.
defensive stocks are also become part of the low volatility strategy. And the fifth, which is less known, actually we know it, but we don't know it's a fifth factor, is the size. So
Mhm.
mid cap and small cap is actually factor. Okay, as you
Mhm.
go the
Correct.
lower the ladder from the market cap wise, that's actually a size factor. That's a fifth factor.
Mhm. Mhm. Okay. Now you said there are five factors are there. Now, as an investor, see the market cycles are there. Sometimes we had a bull market, 2023, 24. Then we had a bear market. And now the market is very volatile, uncertain, unpredictable kind of now situation. So as an investor, I would like to choose a fund or choose a factor which consistently perform over all the cycles in the long term. So which one do you think is the best one now in out of all these factors that you have said?
Yeah. So globally, the best factor is the low volatility factor.
Okay.
Okay,
Mhm.
because the name itself tells you that low volatility, but you'll also understand what low volatility does to my portfolio. Is
Mhm.
actually defensive stocks when they come in my portfolio, whether it
Mhm.
is global financial crisis or taper tantrum or yen devaluation or COVID-19, any crisis. Okay, or
Mm-hmm.
for Ukraine crisis also, war also happened. Any crisis will actually protect my portfolio because these are the defensive stocks in the portfolio. So that's the
Correct.
globally the most popular, and this should be part of your core. Okay, you
Mm-hmm.
can just hold it on and hold it forever in your portfolio. And
Mm-hmm.
the second popular is the momentum. you know
Mm-hmm.
and momentum you will actually not get in active management. Yes, there are few active funds have started coming in active management, but momentum, pure momentum, if you're looking at market momentum, is like what is in trend. So there is a behavior in investors, especially in the stock market, herd mentality. Okay, if I buy something, you hear, you follow, you act, and then there's a repetition which goes on. That trend
Correct.
is captured by momentum, and it is
Mm-hmm.
historically proven. If I give you an analogy of a ball, okay, a cricket ball. If I throw a ball on the ground, till the time it has a velocity, it will just continue to roll it, right? So
Mm-hmm.
you know that there is a particular velocity in that ball. You pick up at midpoint where you know that I have picked up this stock which has just come halfway or quarter way, and now it will still go further. That is nothing but
Mm-hmm.
momentum. So these are the two popular one, but I would recommend any investor quality as well. Okay, where what are you buying? You are actually looking at companies which are quality in nature, very
Mm-hmm.
strong in balance sheet. Their return on equity is very high. Their leverage ratio is low. So and their EPS is consistent. So withstanding any market scenario, any crisis is actually very good, and this can also become part of your core always. Okay, you can just hold it. So if you ask me, on in core, low volatility or quality, which you can just hold on forever, and momentum
Mm-hmm.
you can keep some percentage, because that is going to give you that extra spiciness. Okay.
Mm-hmm.
And value also, I'll tell you how to use it. Value, you do SIP, because value standard deviation
Okay.
is very high. It's almost 25% above, whereas market is usually 14, 15 standard deviation. So it's very high volatility. So long term SIP value will actually give you a better return.
I think wonderful. The way you have explained, you say as a whole, different factors perform. When you talk about momentum, it seems to be very attractive because in
Yep.
the bull market, momentum tends to perform in a better way, right? Gives it. But again, as an investor, you need to have different kind of flavors.
Right.
Now, as you say, the core portfolio should be low vol and as well as quality. This should consist the core portfolio part. Am I right in understanding
Correct.
that, Vikas?
Absolutely. Absolutely.
Okay,
Absolutely.
and then you have said value for SIP, right? If somebody wants to do for
Exactly.
SIP value
Yes.
funds,
Yes.
I say instead of simply closing that momentum is the best or value is the best or the quality is the best. So we need to know how to use, when to use, and how to use. Okay, fantastic. So now you talk about quality parameters. Now again, do you think now it seems talking to you that as an investor, as a long-term mutual fund investor who is building a portfolio, I can build my entire portfolio through this four different kind of factors. Is it correct in understanding that, or it should have all the different spices or different funds, or what should be the weightage of this smart beta funds in my overall portfolio construction?
Yeah. Definitely. So all the smart beta comes at that additional alpha. Okay, so
Hmm.
they are actually designed to give you that additional return over market. Okay,
Correct.
so if you're new investors, definitely you should try with the simple index. You can pick up Nifty 100 or Nifty 500 broad based. Okay, as
Hmm.
your appetite grows, okay, as you understand, yes, need to have quality in my portfolio. If you need to have different flavors in my portfolio, that's where smart beta comes in. So if your 100 rupees is your portfolio, if you're looking at passive, should be 50%, which I believe,
Hmm.
of course, I've been in the industry for 20 years on in the passive side. So I would definitely recommend passive more as a core. In that
Hmm.
50, you can have 30 rupees as broad-based indices, and 20 rupees you can look at smart beta. But there are certain aggressive investors. Okay, they don't want to look at the broad-based indices. They want to look at that additional alpha always. There
Hmm.
you can actually look at combination of these four or combination of two also. Like momentum,
Hmm.
low wall combination you can look at. Okay, or you can look at all four factors. where momentum, value, low all quality, equal weight strategy. We have done that study, and it's a fantastic
Mhm.
portfolio. It's all weather portfolio. Hold it equal weight and just rebalance every quarterly. This
Mhm.
becomes a all weather portfolio in your investments portfolio. Right. So this is
Mhm.
how you can look at, and that other 50% you can always go with an active strategy. And when I say
Mhm.
about active strategy, it's not about only active mutual fund. It's or PMS,
Mhm.
AIF, it's direct stocks, anything and everything which you actually do to generate alpha will become part of that active. This is how you can combine active and passive together.
Okay, okay. So both active as well as passive, 50% in active. Rule of thumb, 50% in passive. And out of this 50%, 20% should be in smart beta fund, right?
Right. Right.
Oh, great. Now let's talk about your, Axis AMC is that Nifty 500 Quality 50 Index. I think NFO is closing on September 4th,
Cool.
right?
Yeah.
So yes, 4th September. So tell us more about it. Already we have got, this kind of smart beta funds are there. So how you are going to differentiate? What is special about your Axis AMC's quality fund?
Yeah. So currently in the market, there are different indices based on quality available on, say, Nifty 100, Nifty 200, mid
Mhm.
cap, and small cap. Okay. So it is giving you different options of choose on different size, market size.
Mhm.
Okay. This indices, in fact, works on the flexi cap concept on entire Nifty 500. Okay. So in
Okay.
single portfolio, you get a combination of large, mid, and small.
Mhm.
Okay, that's first. You'll be surprised to know that when we say quality, okay, quality
Mhm.
means you lies with all the large cap guys. In this
Mhm.
portfolio, out of 50 stocks, okay, 65% stocks actually
Mhm.
falls in mid and small. So
Okay.
40% stocks from mid cap, 26% stocks from small cap. Okay, so
Uh-huh.
that defines our belief that all only big companies are actually coming from in quality or considered to be quality, but it's actually not. Okay,
Mhm.
so this gives you. So now imagine it's a flexi cap portfolio. Again, in the industry, when you look at any active flexi cap portfolio, you will see that there are very high, heavy large cap bias. We just did some
Mhm.
68, 69% as an average, industry average in flexi cap. They keep in large cap. But this
Mhm.
portfolio actually 65% gives you mid and small. And it is not now. Pre-COVID, this was like 72% large cap portfolio.
Okay.
So it's actually a pure flexi cap. So from 72%, now large cap has come down to 33% because you saw there are companies in mid cap and small cap also doing really well. Their return on
Mhm.
equity is growing, their leverage ratio is dropping, their EPS consistency last 5 years has been steady, right?
Mhm.
So this is a complementary approach. If you are looking at a quality investing, if you are looking at a flexi cap investing, this is a complementary approach to any equity, any active strategy which you have on the quality style or flexi cap style. So and
Mhm.
because it's a different portfolio in financial services, I'll talk about one sector. You will not see any
Mhm.
bank. You will see wealth management. You will see broking here. You will see
Mhm.
AMCs. You will see CRISIL,
Mhm.
CAMS,
Mhm.
CDSL, such portfolios. Right? You'll be
Mhm.
surprised to know that Coal India is the number one stock in this portfolio,
Mhm.
right? Which is a value stock, but this is also a
Mhm.
balance sheet, quality balance sheet, and you get
Mhm.
that exposure in this portfolio. So it is a very different portfolio than what you see and what you get in the market as a quality.
Okay. And if I can ask you, like, what are the top constituent of this fund? Which are the, if you can name um,
Sure, sure.
some examples? Yes.
Yeah, sure. So there are, I'll just name they are in front of me. Yeah. So there are top 10 stock weighing around 35.5%. So number one stock is definitely Coal India, followed
Uh-huh.
by Bharat Electronics, Britannia, Colgate, Bajaj Auto, Suzlon,
Right.
HDFC AMC, Adani Power,
Mhm.
Bharat Petroleum, BPCL, and CG Power, Crompton and Greaves.
Mhm.
These are
Mhm.
the top 10 stocks. And then sector, if you see, these are again different sectoral composition. Industrials are
Right.
21%, financial services 18%, IT
Uh-huh.
16%, FMCG 13%, energy 11%. So this is a very very different portfolio than what you see. Most of the flexi cap you will see a bank focus, financial services focus, but this industrial is very high here, right? So that actually is a completely complementary portfolio to whatever you hold in flexi cap and quality style of investing.
Wonderful. Anyway, are you going to take any kind of positions in FNO as well to hedge your portfolio or something like that?
No, this is a completely pure passive strategy. So there is an index which is Nifty 500 Quality 50 index, and we will just
Mm.
replicate it. So it's a pure passive strategy. There is no active management, whether it is in cash market or as well as in FNO market.
Okay, okay. Now, again, because we have got lots of investors, right? There are some investors which are very new to the market. There are some very experienced or somebody in between, right? So, how do you like to advise people to approach this, quality 50 index in this particular fund? Uh,
Yeah,
should they start doing it holding period from the perspective of holding period, long term? Of course, as you said, it should be part of the core portfolio, right? So,
correct.
what would be your advice to our different category of investors?
Yeah. So definitely who is starting newly, first time, okay,
Mhm.
they don't understand what to buy. I would recommend just buy Nifty 500. Okay,
Okay.
buying 500 stocks. But if you
Uh-huh.
think that 500 is too much for me, okay, I need to also look at some quality parameter. Then this index I will recommend Nifty 500 Quality 50, because you are getting a flexi cap approach. You are getting quality balance sheets within that 500, and every 6 months a portfolio gets rebalanced. So you get new stock. Like as I said, pre-COVID it was large cap bias. Now it is mid and small cap bias, right? So it will keep shifting automatically. You need not worry about. So this portfolio for any newcomer, okay, looking at a flexi cap approach. Not only that, any existing portfolio, aggressive investor. So I'm an aggressive investor. I will put this in my core so that my satellite approach, I can go aggressive. I can go aggressive on cost. I can go aggressive on risk also, right? Because the standard deviation of this index is lesser than Nifty 50, Nifty 500. Right. So it doesn't only add returns, it also reduces volatility because of the quality balance sheets of the companies.
So this is very ideal for long-term goal-based kind of an investing, right? Somebody in
Absolutely. Absolutely.
20s, so long-term holding career. I think great
Absolutely.
insight. We have learned a lot. We have covered lot many points today. Now, again, from the fund manager's perspective, you have been in the industry for last 20 years. So, what is going to be your final advice in wealth creation? Because ultimately, at the end of the day, everybody wants to create wealth. People want to be financially successful. They want to retire early. The young
Correct.
generation, So, what is going to be your golden advice? Because see, many times, you know what, people get carried away. When the
Absolutely.
market is a very strong bullish market, people get carried away. When the market is like in a topsy-turvy situation, lots of panic, people get carried away. So, what is going to be your advice as an experience, in the industry? What's the
So,
core
so, so
philosophy to follow?
Absolutely. So first of all, investment has to be serious. If you want to
Okay.
have really fun, investment is
Mm.
not the place. Just go to Las Vegas, take 1,000 crore and $1,000 and just enjoy there, spend there, right? But this
Right.
is not a place to enjoy. Okay, this is a place to stay put for long term.
Mm.
Investment is boring. Okay, and cost plays very important role. Okay,
Mm.
passive as passives are very very simple. Begin your portfolio with passive. As your risk appetite grows, definitely you can increase mid cap, small cap. You can increase, go to active strategies. Okay, but what you said that in especially stock market investing or mutual fund investing, in short term you will see it is driven by emotions. In long term, it is driven by fundamentals. Right, so definitely invest in fundamental, and indices are the great example of fundamentals. That is why they are sitting there. That is why they are called benchmark. So put indices, put passive as a core of your investing, and hold on. Take investment seriously. Have fun outside.
Okay, so take investing seriously, and if you look for excitement, go somewhere else. More
Correct.
boring is the portfolio, the more beneficial it is for the investor, right?
Absolutely.
So
Absolutely.
you have to keep your portfolio boring, and
Yes.
here quality comes.
Yes. Quality comes.
Yes, I think lovely talking to you because we have discussed a lot. The key points, very important points from the investor's perspective, we have covered up. We'll catch up some other day. We'll discuss some other topic and
Sure.
looking forward to have some more discussion in future. And thank you, our viewers. Thank you, everyone. Thank you.
Thank you so much. Thank you, Neeraj, for inviting. Thank you so much. Yeah.
Thank
Happy
you.
investing.
Thank you.
Investments in the securities market are subject to market risk. Read all the related documents carefully before investing.